Welcome back to another video. My name's Connor, I hope you're doing well, and today I want to take a look at whether or not you should invest in stocks or property. Okay, we're going to compare the two and make a decision on which I feel is best in most situations. Okay, I'm not giving you personal financial advice, I can't do that, so don't think that this is financial advice specific to you. For example, when it comes to stocks and property, you have a multitude of options. It can seem overwhelming. Property, you have, do you want to invest in a single family 2-bed residential property that gives you a 3% capital growth and a 7% yield? Or what about a 1-bed property that gives you a 1% capital growth but a 9% yield? And then you've got the option of REITs or commercial property. And then if we flip on over to stocks, you've got potentially even more options because there's so many individual aspects to it. So you've got individual stocks, and if you want to go with individual stocks, do you want to choose growth and tech, or do you want to choose value, or what about dividends? Or you've got an ETF, or you've got an index fund, or you've got call and put options, so you've got the trading aspect, okay? So there are so many choices out there that you can choose from. But in this video, I want to try and give you a bit of a helping hand and hopefully arm you with the information you need to make the best investment decision for you. Again, this is not financial advice. So let's start with property investment, okay? And I'm going to say that we have a £30,000 investment pot for both property and stocks, all right? But £30,000 property, what can we do with that? Well, I'm going to jump onto the iPad and write down these numbers, okay? So I have found a property in Gant Street, I don't know if that's how you say it, in Lincoln, with a sale price of £90,000, but is actually worth £110,000, but it's under market value because it needs a little bit of work. We're not talking a lot, this is not a full refurb. We're going to struggle to do a full refurb for £30,000, okay? But this is the property example I'm giving. We have £90,000 sale price, okay? Boom. Then, on a sale price of £90,000, we have a deposit of 25% because we need to have a 75% loan to value for buy-to-let mortgage, £22,500, okay? So deposit, it's coming in at 22,500. Then we're going to assume that we have a house already. So unfortunately, we're going to have to pay 3% stamp duty, okay? Which on this property comes in at £2,700, okay? Now the refurb I'm going to be putting in, and I'm using refurb lightly here because this is not a full-on refurb, but I'm going to put a refurb cost in of £3,000, okay? So that will give us the opportunity to change things like maybe a couple of doors, skirting boards, a paint here and there, maybe if a room needs a replaster because there's some horrible wallpaper or anything like that. We're going to be able to do that here, okay? This is more of a turnkey property than one where you're going to go in and going to have to rip everything out and start from scratch, all right? That's not what this property is. So we do, of course, have other costs associated with buying a house. So we've got things like solicitors, we've got broker fee, and we also have things like surveys and all that good stuff. Okay, so that's going to use up the remainder of our money. So we so far have spent £30,000 on this property. So what do the numbers look like on this property? So I know that we can achieve a rent per calendar month on a property like this in this street of £525 a month, okay? So 525 a month. Now in terms of mortgage, we know that we put down 22,500, okay? So with a mortgage term of 25 years, okay, at 3% interest on a buy-to-let mortgage, okay, with a mortgage of 67,500. The total cost per month for this mortgage is going to come in at £168.75p. Okay? So that's our cost right there, £168.75p. Okay? Now, there are some additional costs that come along, which we're going to add in because I think it's fair to do that. Okay? So we have a 10% managing agent fee, okay? Managing agent. which on this example comes in at £52.50. Okay, so we've got that. That's one. Number two, we are going to have landlord insurance. I've allowed £25, okay, for landlord insurance. And then I also like to chuck in maintenance. Maintenance on this property, I've allowed £50 per month, okay? So that then gives us a total for all those three items of £127.50. So what does our return on this property look like in the first year? Well, net annual cash flow, okay? So rent minus mortgage payment for the year comes in at £2,430, okay? So per month net, that is £202, okay? So that's £202 in your back pocket every single month, right? After the maintenance fee, after land insurance, after the mortgage, after the managing agent fee, you are netting £202, okay? Now, this property in particular, if we're looking at this one here, is a 6.58% yield, okay? So, with a net of 2.54 net, okay? So it's not the best, but it's not the worst, okay? It's in a good area, it's a good property to buy. So, what about, this is where property gets interesting, because what about the 10-year? A 10-year range is where things start to get interesting with property. Because if we assume a growth rate of 4.3% over 10 years, okay, which has been the return on average over the last 10 years. So I'm just following that over, okay? Our £90,000 property, okay, so our original property of £90,000 is now worth £167,585. That is what compounded annual growth will do to a property, okay? That means that our equity in this property after 10 years, okay, comes in at £100,000, at £100,085, sorry, okay? That is what we have in equity that we could take out if we so wished to sell the house after 10 years. Now, remember, the mortgage has not been being paid down because we chose interest only for tax purposes, and also because it means that we can be more agile. We're not paying down a mortgage. That's something that you let time pay down the mortgage, okay? Now, something else which we have been receiving, and I have allowed a 1% rent appreciation for every year, is the rent coming every month, okay? So what does the rent equal over 10 years? Well, it comes in, rent, okay, for 10 years, comes in at £25,000, okay, £220. If we take our equity plus our rental income for the 10 years, we have made, from a £30,000 investment, okay, we have made £125,305, okay? That is from a £30,000 investment. That is the power of property and leveraging property. We were able, 10 years ago, to buy a property for £90,000 with an initial value of £110,000, but we bought it under market value, which in 10 years has grown to be worth £167,000, giving us £125,305 in net worth. How do stocks compare? Because we all know how great property is, and we can see it right here with this number. It's incredible. But what about stocks? Because stocks were my first love. They were, I love stock, and I still invest in stock today, and I love them, and I love getting stuck into the numbers and reading annual reports and all that boring stuff that nobody else really likes to do. So in this example, again, we're going to take our £30,000 and we're going to put it into a standard index fund. Low monthly fee, it's like 0.02% or something for an index fund. I can't remember the exact number, but they're so low because they're not managed, they're not actively managed. So in this example, we're going to use the S&P 500, okay? And we'll use S&P because one, it's the index that I invest in. It's the index that has performed historically very, very well. And it's also just, it's one of, it's the biggest American index. It's really well known, okay? So Warren Buffett's Berkshire Hathaway tracked the S&P 500 right the way back to 1965 and found that between 1965 and 2021, the S&P returned an annual compounded growth of 10.5%, okay? So 10-year compounded growth was 10.5%, okay? Remember that number, 10.5%. So if we take our £30,000 investment, okay, and invest that in the S&P 500 and allow that to compound for 10 years at 10.5%, so times 10.5% over 10 years, okay, we are left with, at the end of our 10-year investment, we are left with £81,422. Okay, so if we remember property, what were we left with? £125,305. Okay, that's a massive difference. Now, of course, none of this is guaranteed. These numbers here were to give an example, so none of this was guaranteed. Okay, but this is fairly standard within property and stocks. This is, I'm looking at historical averages here. These, the numbers I've taken are not random numbers that I plucked out of the air. I've used the historical numbers from 10 years gone by, and although we've been living through an odd few years here and there, I think this is a fair assessment of stocks versus property. Now, to answer the question, what should you invest in? My personal opinion is both. Okay, the way that I look at it is I use stocks as a place I receive income, I invest in stocks to build up my property buying pot. Okay, so because let's be honest, the banks are giving us nothing. So we need to make money somewhere. We need to be earning interest on our money somewhere. And the stock market is the best place to do that while you build up a big enough pot to buy your next property. Okay, so that's what I do. And when I have enough, I then take that money out of the stock market and I use it as a deposit on a property. Okay, now for me, property wins overall. I think until you reach a net worth of about £1 million. At £1 million, you can start making some waves in the stock market because all of a sudden dividends actually become something that you will notice coming into your bank account. Below that, you can't, if you only have £30,000 and you invest in dividend stocks, you're going to be maybe £10 a month, maybe £20 a month, maybe £30. You're not going to be making hundreds or thousands of pounds every month in dividend income with a £30,000 investment. Again, with a lot of investing, what happens is you see exponential growth the longer you're in the market. So if we had run these numbers for 20 or 30 years, what you would have seen is that from 0 to 5, you would have been like this. From 5 to 10, you would have been like this. And then from 10 upwards, all of a sudden, that impact of compounded growth really takes hold and you shoot up like this, okay? So guys, there we have it. I hope that video was useful. I really do. I hope it kind of gives you a bit of an insight into what I like to do and also the power of property investing. Property investing is extremely powerful in building wealth, and it's why it has made so many millionaires. So if you found this video useful, please do tap that little subscribe button and hit the like button, and I will see you in the next one.